Hello, and welcome to this edition of the ESOP University presented by PCE Investment Bankers. PCE is an investment bank providing both M&A and ESOP transaction services to middle market businesses. Today, we are discussing the specifics surrounding financing the sale of your company to an ESOP. My name is Eric Zaleski, and I'm an investment banker with PCE, and I'm located in our Chicago office. Let's get started with today's topic. When moving forward with an ESOP transaction, financing is a fundamental piece in the process and is one that is on top of the mind to sellers. So what are the key concepts you need to know about financing an ESOP transaction? The company will assume the debt and maintain it on its balance sheet like any operating debt the company has, such as a line of credit, term debt, mortgage, etc. This creates company balance sheet leverage, which the capital provider will take into consideration when providing the liquidity to the sellers. The wonderful thing about financing in an ESOP transaction is there are multiple options to consider, and all should be evaluated for the best solution to the sellers. Sometimes there's a misconception that financing in an ESOP will help inject cash into the business for company use. ESOP financing does not come into play with the goal of using financing to support company growth, acquisitions, or any type of bridge financing for operations. Obtaining financing in an ESOP transaction must incorporate three considerations. At the core, it is used as liquidity to the sellers, which turns your stock and equity investment into cash and diversification. Some questions to address include, what does the seller want to accomplish from a cash out need? How much can the company comfortably afford to repay the debt associated with the cash out, while still considering the credit needs to continue to run and grow the business? How do we partner with the right capital providers and those that understand our business? Determining this involves analyzing and seeking the best terms and conditions for all three considerations. A detailed company forecast is vital in the normal course of business with company planning. However, when going through an ESOP transaction and specifically seeking financing, it will provide the pathway for making correct decisions. A 3 to 5 year forecast is likely needed, and if one is currently not prepared, it's advisable to implement now. Capital providers will analyze your historical and projected financial statements to determine the ability to service the debt. You should take into account the operating and growth needs within these projections as well. The lenders will likely stress test the projections, specifically if the future earnings vary material than the historical earnings. Approaching your financing with understanding of the transaction parameters will reflect your knowledge of the debt request. Rely on your investment banker who has market knowledge, strong relationships with banks, and the ability to talk to the bank through their language. They will explain the deal parameters, different scenarios, and requirements the bank will have that will help you sell your company like you would to potential clients. Remember, you want their business just as much as they want yours. Outline the overall transaction, including value of your company, structure, terms, and considerations, and all the professionals involved. Take this opportunity to be on offense and to be responsive and organized. Combining all of these strategies will ensure your success in achieving the goals. The selection process of your capital provider should be carefully vetted. Start with the company's existing bank. There is an established relationship, likely over multiple years. They know how your business operates, who is involved, management of cash and loan repayment history, and this will improve to be an efficient approach to your capital needs. However, there are times when your existing bank may not understand ESOPs or be comfortable lending the amount of debt in a transaction. When this occurs, it's prudent to expand the search to banks with ESOP experience. Regional banks are a great place to start but also the mega banks fully understand and welcome ESOP transactions. Most all can lend nationally, so geography is not necessarily an impediment. Their ESOP-specific underwriting knowledge is important to allow your investment banker to manage the process on time and within schedule. It is worthwhile considering alternative sources of capital which are more flexible and can work with your existing bank in a secondary or subordinate position. However, they are more expensive and may come with additional oversight. When it's prudent for your investment banker to take the transaction to market to multiple banks, it provides a competitive environment for the best options and structure. There are two financing sources typically, bank financing or seller financing, or you can do a combination of both. Bank financing at or senior financing contains pros and cons. Usually at the top of mind is how much cash I will receive at closing. Banks satisfy this need and they are usually at advantageous terms. A 5 to 7 year repayment term coupled with low interest rates makes senior banks very attractive in all ESOP transactions. Consequently, as a bank is now your partner, other considerations of bank oversight come into play. The bank looks at the overall collateral and what financial covenants it can put in place to ensure the ability to repay debt. Financial covenants are standard with ESOP transactions. And furthermore, banks have regulators and are subject to market risk just as companies are. The regulators can dictate terms and conditions the bank's willing to extend. Leverage is a key term in banking as it reflects the amount of debt and capacity a company can take on versus its cash flow to repay that debt. Following the Great Recession, banks have had a strict guideline on how much leverage they can provide a company. This is not only true in general financing, but also in an ESOP transaction. An ESOP transaction is likely going to be unsecured, creating potentially more risk for the bank. Therefore, banks address the amount of leverage to provide based on the size of the company's cash flow. If you have high and recurring EBITDA, you are likely to receive more leverage, which equates to more liquidity at closing. Consequently, lower and large fluctuations in your EBITDA may allow for lower liquidity at closing. As you continue to repay your loan over time, the bank gains comfort and may look to increase your leverage and liquidity if there is any secondary or seller debt to refinance. Collateral is important to all lenders as a reliance upon a backstop to pay off their debt if cash flow is unavailable. In most ESOP transactions, debt provided by the lenders is not collateralized. That's why it's important to partner with the right bank on your transaction to ensure they understand the overall structure just as much as you do. If collateral is available, the terms on the loan can be more favorable. Having a strong management team in place shows the bank depth, professionalism, and diversification of responsibilities. This likely provides comfort in a situation whereby the company isn't dependent on just one person. Seller financing also contains pros and cons. At inception, seller financing trades your current stock and equity investment risk into note and debt risk. This is a major consideration when evaluating financing and risk diversification. Seller financing comes with the benefits of allowing you to control the debt repayment, earn a good yield on your investment, allow for potential upside or extra cash payout down the road through a warrant, and provide you a quicker close. In a 100% sale of your company, you will be required to have seller debt. As previously discussed, the lending market is regulated as to the amount of leverage it is allowed to provide, and the gap in net leverage is usually financed with seller debt. One important downside to consider with seller notes is that there isn't any cash in hand provided at closing. However, in exchange, you won't be beholden to the bank's covenants, oversight, and closing costs. As previously mentioned, multiple levels and structures in financing are available. Varying degrees, requirements, terms and conditions, and secondary information all come into play. Identifying your objectives will help your investment banker narrow down the options to focus on. The typical structure in an ESOP transaction is centered around a cash flow senior loan. They are likely considered unsecured with a few more stipulations, such as loan covenants, than those of a senior secured loan. However, it provides a balance between borrower and lender with consideration given on both sides. As stated, both bank and seller financing have their pros and cons. To determine which is best for you, an all-encompassing approach is prudent. Summarizing, the bank offers many positives along with seller financing. As discussed in one of our earlier classes, PCE's transaction process, it is important to review and weigh all of your options. It's not a one-size-fits-all approach, and you may find out that bank financing, seller financing, or a combination of both will satisfy your goals. Thanks for joining me today. We welcome your comments and questions, so please feel free to contact me at my information listed here. And if you like this presentation, please subscribe to our YouTube channel so that you'll be notified whenever new content is posted.